If you're over 65, I need you to listen very carefully. I want to talk about the money you've worked your entire life to save, the money you're counting on for a secure retirement. You've probably been told to put it in a safe place like a savings account or a CD. You check the balance, you see the numbers are stable, maybe even ticking up by a few dollars, and you feel secure. But I'm here to tell you that for millions of Americans, that feeling of security is a dangerous illusion. There is a silent thief that is systematically draining the real value of your nest egg, and the very banks you trust are helping it happen. This isn't about a scam or a market crash. It's about something far more insidious, because it happens right out in the open, disguised as responsible financial advice. Today, I'm going to expose the 3 safe savings accounts that are actually making you poorer every single day. To show you what I mean, let me tell you about a woman named Margaret. At 68, Margaret was the picture of financial prudence. She'd spent decades building her savings, and she believed with all her heart that her money was safe. She had 3 different accounts, all recommended by smiling, well-meaning bank representatives as safe options for someone her age. But one morning, sitting at her kitchen table surrounded by bank statements, she discovered a devastating truth. A truth that began with a simple question from her grandson, a recent finance grad. He asked, "Grandma, when's the last time you actually calculated what your money is earning versus what inflation is doing?" Margaret had brushed it off. "Safe and steady wins the race," she told him. But that question planted a seed of doubt, so she finally sat down with a calculator and her statements. And what she found should be a wake-up call for every single person watching this. The first thing she did was look up the current inflation rate. The number that stared back at her from her phone was 3.2%. That means that, on average, the cost of everything, from groceries to gas to healthcare, was going up by 3.2% that year. For her savings to maintain their value, to be able to buy the same amount of stuff next year as it can today, it needed to be growing by at least 3.2%. With that number in her head, she looked at her accounts, and that's when her stomach dropped. The mathematics were simple and heartbreaking. Her carefully hoarded nest egg wasn't safe. It was slowly losing its power. Let's break down the 3 accounts that were failing her, because chances are your money is in one of them right now. The first culprit is the most common one, the traditional savings account. This is the account that probably holds the bulk of your retirement funds. It's the one the bank representative pitches as the foundation of security. They talk in soothing tones about FDIC insurance, which protects your deposits up to $250,000. They highlight the liquidity, meaning you can access your money anytime. They stress the stability. Your balance will never go down. And that's exactly what they sold Margaret. At First National Bank, her primary savings account was earning a whopping 0.25% annual percentage yield. On paper, that sounds like a positive number. But let's do the math. Margaret had $200,000 in this account. At 0.25%, she was earning just $500 a year in interest, less than $42 a month. But remember inflation? At 3.2%, that same $200,000 was losing $6,400 in purchasing power every single year. So while the bank was paying her $500, the cost of living was stealing $6,400. The net effect was a real loss of nearly $6,000 a year. The safety she thought she had was safety from the wrong kind of risk. She was protected from short-term market swings, but she was completely exposed to the slow, certain, long-term risk of inflation. The bank, meanwhile, was taking her $200,000, lending it out for car loans and mortgages at 5, 6, or 7%, and making a fortune while her own wealth slowly evaporated. The second account that's quietly stealing your future is the high-yield savings account. Now, this one is particularly insidious because the marketing is designed to make you feel smart. A neighbor told Margaret about a high-yield account at Community Savings and Loan that was paying 0.40%. Compared to her 0.25%, it seemed like a fantastic deal. She felt clever for finding it. But let's be clear. High yield is a meaningless marketing term when the yield is still far below the rate of inflation. Margaret's $150,000 in this account was earning $600 a year. but it was still losing $4,800 in purchasing power to that 3.2% inflation rate. Do you see the trap? By calling it high yield, the bank creates the impression that you're getting a great return. In reality, you're just getting a slightly less terrible deal. The small improvement masks the much bigger problem, the absolute inadequacy of the returns. Margaret was so pleased with herself for earning an extra 0.15% that she never stopped to ask the most important question: is 0.40% enough to protect my money's value? The answer was a resounding no. This brings us to the third and most frustrating account, the certificate of deposit, or CD. When Margaret opened her CD, the bank representative made it sound like the most responsible choice a retiree could possibly make. The interest rate of 1.2% was locked in for 3 years. Her principal was guaranteed. Her money was completely safe. The representative even framed the early withdrawal penalty as a good thing, a form of enforced discipline. So Margaret put $137,000 into this CD, attracted by the certainty of that 1.2% return. What she didn't realize was that she was locking in a guaranteed loss. Even at 1.2%, her money was still losing nearly 2% of its value every single year to inflation. And worse, she was trapped. She couldn't access her own money to move it to a better investment without paying a substantial penalty. The bank had convinced her to pay them for the privilege of losing money at a guaranteed rate for 3 years. The CD represented everything that was wrong with the advice Margaret had received. The bank focused entirely on the safety of her principal, the dollar amount in the account, while completely ignoring the safety of her purchasing power, what those dollars could actually buy. As Margaret sat at her table, she realized the devastating truth. The very accounts meant to protect her were slowly stealing her financial security. Over the 5 years since her husband had passed away, her conservative strategy had cost her approximately $65,000 in purchasing power. $65,000 vanished into thin air, not because of a bad investment, but because of safe ones. The lost opportunity was staggering. Margaret realized she'd essentially paid $65,000 over 5 years for the illusion of safety, money that could have funded years of additional retirement security or left a larger inheritance for her children and grandchildren. The banks had profited handsomely from her deposits while she'd grown progressively poorer in real terms, all while congratulating herself on her financial prudence. Margaret's research also revealed that her experience was becoming increasingly common as interest rates remained low while inflation began to rise. Millions of retirees who had followed similar strategies were facing the same slow-motion erosion of their wealth. The financial media was beginning to acknowledge the problem, but many seniors remained unaware of the damage being done to their retirement security by their safe choices. The psychological impact of this discovery was almost as significant as the financial impact. Margaret had to confront the reality that she'd been making poor decisions for years while believing she was being responsible. She'd dismissed her grandson's concerns and resisted her children's suggestions about seeking professional advice, confident in her own understanding of what constituted safe money management. The humbling realization that she'd been wrong about something so fundamental to her security was difficult to accept. Margaret decided she needed to have honest conversations with her family about what she'd discovered. She called David first, her eldest son who had always been the most financially minded of her children. David listened patiently as she explained her calculations and her newfound understanding of the inflation problem. "Mom," David said when she finished, "I'm proud of you for figuring this out, but I have to ask, why didn't you want to talk to a financial advisor when I suggested it 2 years ago?" Margaret sighed. "I thought I didn't need one. The bank people seemed to know what they were talking about, and everything they recommended sounded so safe and sensible. I guess I was intimidated by the idea of working with someone who might try to sell me risky investments. But Mom, keeping all your money in savings accounts was risky too. You just couldn't see the risk because it was gradual instead of sudden." David was right, and Margaret knew it. She'd been so concerned with avoiding dramatic losses that she'd accepted gradual losses instead. The irony was that over time the gradual losses were likely to be much more significant than any temporary market declines she might have experienced with a more balanced investment approach. Margaret's next call was to Tommy, the grandson whose casual comment had started her down this path of discovery. Tommy was excited to hear that she'd taken his suggestion seriously. "Grandma, I'm so glad you looked into this," Tommy said. "I was worried about bringing it up because I didn't want you to think I was criticizing Grandpa's financial decisions or suggesting you couldn't manage your own money." "Your grandfather was a good man and a smart man," Margaret replied, "but he managed our money during a very different time. Interest rates were higher then, and inflation wasn't the same kind of concern. What worked for him 20 years ago doesn't necessarily work for me today." Tommy offered to help Margaret research her options, and she gratefully accepted. Together, they spent hours on video calls going through different investment alternatives. Tommy's recent finance education combined with Margaret's newfound motivation made for a productive partnership. What emerged from their research was a clearer picture of how Margaret might restructure her savings to better protect her wealth from inflation, while still maintaining an appropriate level of safety. They looked at Treasury inflation-protected securities, TIPS, which adjusted their value based on inflation rates. They studied conservative bond funds that could provide better yields. They explored dividend-paying stocks from established companies with long histories of increasing their payments. Margaret began to understand that the choice wasn't simply between safe savings accounts and risky stocks. There was a broad spectrum of investment options, and she could construct a portfolio that addressed her need for both growth and security. The key was understanding that inflation risk was just as real as market risk, and that a truly conservative approach needed to address both. As Margaret educated herself, she began to think about the broader implications. How many other seniors were in similar positions? How many bank representatives were steering older customers toward products that served the bank's interests rather than the customers? Margaret decided to document her experience in a journal, both to organize her thoughts and as a potential warning to others. Writing about her experience helped her process the anger at being misled, the frustration with her own naivety, and the determination to make better choices. The journal also helped Margaret recognize patterns in how she'd been approached. Looking back, she could see how bank representatives had used her age and her concerns about risk to guide her toward products that weren't in her best interest. They'd spoken in reassuring tones about safety, while failing to mention the very real risks of inflation. Margaret's growing awareness of these manipulation tactics made her even more determined. She realized that she couldn't simply trust financial institutions to have her best interests at heart. She needed to understand enough to make informed decisions and to ask the right questions. The process of educating herself was challenging, but also empowering. Margaret discovered that she was capable of understanding complex financial concepts when they were explained clearly. Her research led her to seek out fee-only financial advisors who were legally required to act in their clients' best interests, rather than selling products that generated commissions. She learned to ask about fiduciary responsibility and to understand the difference between advisors held to a fiduciary standard and those only required to make suitable recommendations. The distinction was crucial. Bank representatives could legally recommend products that weren't optimal for their clients, as long as they met a basic standard of suitability. Fiduciary advisors, by contrast, were required to recommend what was best for their clients, even if it meant lower compensation for the advisor. Margaret interviewed several potential advisors, armed with her newfound knowledge. She was surprised by how different their approaches were. One advisor in particular, Sarah Martinez, impressed Margaret with her straightforward approach. Sarah had been working with retirees for over 15 years and specialized in helping clients transition from accumulation to wealth preservation. "Mrs. Thornfield," Sarah said during their first meeting, "the most important thing to understand is that at your age, you're not just trying to preserve your wealth. You're trying to make it last for potentially 20 or 30 more years. That means you need it to grow enough to keep pace with inflation." Sarah's approach resonated with Margaret because it acknowledged both her need for security and her need for growth. Together, Margaret and Sarah developed a strategy that would gradually move Margaret's money out of her underperforming savings accounts and into a more diversified mix of investments. The plan included short-term Treasury bills for money Margaret might need within the next year or two, intermediate-term bonds for funds she wouldn't need for several years, and a conservative mix of stock investments for money that could remain invested for the long term. The strategy wasn't revolutionary, but it was dramatically different from her current approach. Instead of earning less than 1% while losing 3% to inflation, Margaret's new portfolio was designed to potentially earn 4 to 6% annually over the long term, allowing her wealth to grow in real terms rather than shrinking. Sarah also helped Margaret understand the tax implications. The minimal interest from her savings accounts was still taxable, meaning her after-tax returns were even worse. By contrast, some of the new investments would generate tax-advantaged income. The process of implementing the new strategy required patience. She couldn't simply withdraw all her money without triggering penalties, particularly from the CD that still had over a year remaining. Sarah helped her develop a timeline for gradually restructuring her investments. Margaret also had to overcome her own emotional resistance. After years of believing savings accounts were the safest option, the idea of stocks and bonds felt frightening. Sarah worked with her to address these concerns, helping her understand that the gradual approach would minimize risks while still addressing the inflation problem. One of the most difficult aspects was dealing with the bank representatives. When she went to withdraw funds, they tried to convince her to stay by offering slightly higher rates. Margaret was prepared for these retention attempts. She understood the banks had a financial incentive to keep her deposits, and that any last-minute offers were likely to be improvements on inadequate products rather than truly competitive alternatives. She politely but firmly declined. The early withdrawal penalty on her CD was substantial, nearly $2,000. However, Sarah's calculations showed that even after paying this penalty, she would be better off. The penalty was painful in the short term, but made sense as part of a long-term strategy. As Margaret began implementing her new strategy, she started to see small but meaningful improvements. Her monthly investment statements showed returns that, while modest, were actually positive in real terms after accounting for inflation. For the first time in years, her wealth was growing in purchasing power. The psychological impact was significant. She felt more in control of her financial future and more confident in her ability to maintain her independence. She also began sharing her story with friends and family, discovering that several of her peers had made the same mistakes. One conversation was particularly memorable. Margaret's sister Janet, who had invested in stocks and mutual funds years earlier, had been dealing with criticism from family who thought her investments were too risky. "Janet," Margaret said, "I owe you an apology. I used to think you were being reckless, but now I understand that I was the one taking the bigger risk." Their conversation helped Margaret realize that there was no perfect investment strategy. Every approach involved trade-offs and risks. The key was understanding those risks and making conscious decisions. Margaret's experience also taught her valuable lessons about seeking financial advice. She realized she needed to be an informed consumer. This new approach extended beyond just investments. She began scrutinizing all of her financial services relationships, from checking account fees to credit card terms to insurance policies. She discovered her passive approach had cost her money in other ways as well. The process of taking control was empowering but also exhausting. However, she also felt more confident and optimistic about her financial future. 1 year after her initial discovery, Margaret reflected on how much her situation had changed. Her portfolio was performing better than she'd expected, generating returns that not only kept pace with inflation, but provided real growth. More importantly, she felt educated and empowered. Her story had a broader impact as well. Her willingness to share her experience led to conversations in her community about financial literacy for seniors. She began volunteering with a local organization that provided financial education to older adults, helping others avoid her mistakes. Through this work, she met many other seniors who had been similarly misled. She heard stories of widows and widowers, steered into inappropriate products during vulnerable times. These conversations reinforced her belief that her experience wasn't unique. The financial services industry had systematically targeted older customers with products that appeared safe, but were actually risky from a wealth preservation standpoint. Margaret's volunteer work also taught her about the broader economic forces that had contributed to her situation. The Federal Reserve's low interest rate policies, designed to stimulate economic growth, had made it nearly impossible for savers to earn meaningful returns. This understanding helped her see her situation in a broader context but also reinforced her determination to help other seniors. She developed a presentation about the hidden costs of safe savings accounts that she gave to community groups, focusing on 3 key points. Safety is about preserving purchasing power. Diversification is key, and seniors need to be active and informed consumers. The response was overwhelmingly positive. Many attendees shared their own stories of frustration. Margaret also worked with local media outlets to share her story more broadly. A newspaper article generated dozens of calls from readers. She found herself becoming an informal advocate for financial literacy among seniors, a role she never would have imagined. Through all of these activities, she continued to manage her own investments with Sarah's guidance. The transition hadn't been without its challenges. There were months when her investment returns were negative, and she had to resist the urge to move everything back to the supposed safety of bank accounts. However, over time, the superior long-term performance of her diversified portfolio validated her decision. One particularly challenging period came about 18 months after she had begun implementing her new strategy. A combination of economic concerns and geopolitical tensions caused stock markets to decline sharply. Margaret watched her portfolio value drop by nearly $15,000 over a month, and the temptation to move everything back to savings was almost overwhelming. She called Sarah in a state of near panic. "Sarah, maybe this was a mistake. I've lost more money in the past month than I earned in interest over 3 years. Maybe I should just accept lower returns and avoid this kind of stress." Sarah listened patiently. "Margaret, I understand why you're worried, but let's put this in perspective. Over the past 18 months, even including this recent decline, your portfolio has earned approximately 4.2% annually. During that same period, inflation has averaged about 3.1%. That means your wealth has grown in real terms. If you had kept your money in those savings accounts, you would have lost about $22,000 in purchasing power over the same period. The temporary decline you're experiencing now is still better than the permanent decline you would have experienced." This perspective helped Margaret regain her composure and stick with her plan. The market volatility that had seemed so frightening was actually less damaging to her wealth than the steady erosion of inflation had been. Within 2 months, the market had recovered most of its losses. The experience taught her an important lesson about the difference between temporary setbacks and permanent losses. The decline in her portfolio was temporary, but the purchasing power lost to inflation was gone forever. Margaret's growing confidence also led her to become more critical of the financial advice industry. She began documenting examples of misleading marketing she encountered. One particularly egregious example involved a bank aggressively marketing senior-friendly CDs with rates that appeared attractive but were below inflation. The marketing emphasized safety while using small print to disclose the actual rates. Margaret brought this to the attention of local regulators, arguing that the marketing was misleading. Her advocacy also put her in contact with policymakers and researchers. Her personal story became part of a broader conversation about how to help older Americans navigate a complex financial landscape. One researcher, Dr. Emily Richardson, interviewed Margaret extensively and used her case as part of a broader study on retirement security. Mrs. Thornfield's experience illustrates a fundamental problem with how we think about financial risk, Dr. Richardson explained in her research paper. Traditional measures of safety focus on short-term volatility and principal protection, but they ignore the very real risk of inflation. For long-term investors, especially retirees, inflation risk can be much more significant than market risk. Dr. Richardson's research helped validate Margaret's decision and highlighted the broader policy implications. Margaret found it gratifying to know her personal experience was contributing to a broader understanding, but she remained focused on helping individual seniors. Her volunteer work continued to be deeply rewarding. One particularly memorable case involved a widow named Eleanor who had been convinced to put her entire $300,000 inheritance into a series of low-yield CDs. When Eleanor attended one of Margaret's presentations, she was shocked. With Margaret's guidance, Eleanor began working with a fiduciary financial advisor. The transition wasn't easy, but over time she became more comfortable with the idea that some market risk was necessary. Eleanor's successful transition reinforced Margaret's belief in the importance of financial education. Margaret's experience also had an impact on her relationships with her bank representatives. During one encounter at First National Bank, she spoke with the representative who had originally helped her. "Mr. Johnson," she said, "I wanted you to know that I've moved most of my money out of the savings account you recommended. I've learned that the returns weren't keeping pace with inflation." Mr. Johnson seemed genuinely surprised. "Mrs. Thornfield, I'm sorry to hear you weren't satisfied. We always try to recommend the safest options for our senior customers." Margaret realized he either didn't understand the inflation issue or was choosing to ignore it. "Mr. Johnson, the problem isn't that you don't have better products. It's that you didn't explain the real risks. You told me my money would be safe, but you didn't mention it would lose purchasing power over time." The conversation was uncomfortable but important. Margaret's journey from financial naivety to informed advocacy took place over 3 years. During that time, she not only transformed her own financial situation but also helped dozens of other seniors. The financial results were substantial. By the end of the 3rd year, her portfolio had grown to approximately $535,000, from the $487,000 she had started with. If she had continued her original approach, her purchasing power would have declined to approximately $445,000 in constant dollars. The difference of $90,000 represented the real cost of her safe strategy. Beyond the financial impact, she felt more confident and connected to her community. The story of Margaret's financial awakening also had implications for how families discuss money. Her experience demonstrated the importance of ongoing education and communication. Her children learned from her experience to be more proactive in their own planning. The broader community impact was also significant. The financial literacy workshops she helped organize attracted hundreds, and local banks began facing more informed questions from senior customers. Her story was eventually featured in a national magazine, bringing her message to an even broader audience. One touching letter came from a man in Florida whose wife had died recently, leaving him to manage their finances alone. He had been considering putting all their money into CDs, but Margaret's story convinced him to seek professional advice. "Mrs. Thornfield," he wrote, "your willingness to share your mistakes probably saved me from making the same ones." Letters like this reinforced Margaret's belief in the importance of her work. As she entered her 70s, she reflected on the unexpected direction her retirement had taken. Her journey had been challenging but ultimately rewarding, giving her a sense of purpose. Her story illustrated several important lessons about personal finance, consumer protection, and the challenges facing older Americans. It demonstrated that financial safety couldn't be achieved simply by avoiding market risk. It required a comprehensive approach that addressed inflation risk, longevity risk, and the need for long-term wealth preservation. Perhaps most importantly, her story demonstrated the possibility of positive change at any age. Despite being in her late 60s, Margaret was able to educate herself, make significant changes, and ultimately improve both her financial situation and her overall quality of life. The legacy of her experience extended far beyond her own financial success. Through her advocacy, she had helped create a more informed and empowered community of senior investors, better equipped to protect their wealth and avoid the costly mistakes that had once threatened her own financial security.